Good morning, class. This is our eighth and last lecture for the course, and we're going to be covering Chapter 29, which deals with investor protection and corporate governance. Corporate governance part being an interesting area to me in terms of looking at it from a businessman and also as a lawyer. So we'll go through investor protection first, and that really just involves two major laws that were passed. Give you a little quick background. Many of you're all too young to recall this. I am too. I learned it in my history classes, but I'm sure you've probably heard of the Great Depression in 1929. So let me give you the background of that and these two laws that we're going to look at today. 1929, October 1929 was when the stock market crashed. Up to that point, from the late 1800s through the 1920s, you may recall hearing the Roaring Twenties. American business was just going crazy. The expansion was enormous. The growth in wealth was enormous, and had become an economic powerhouse. Maybe you might even say something like China is today. We just were blooming as an economic industrial power. And with that came all kinds of financial machinations, and you might even call it game playing, if you will, or just people trying to make a fast buck. And a quick place to do that was on the stock market. We had formed and gotten a stock market going in the country. People were buying and selling securities and all kinds of businesses and whatnot. And there was no regulation of any kind. So the government just kind of sat back and watched all this going on. And what occurred, at least as far as the stock market is concerned, it's not a whole lot different than when we had the corporate scandals in 2002. Or when we had the mortgage meltdown in 2007. It was purely and simply a situation of people getting overly greedy, forgetting anything, if knowing anything at all about ethics or right behavior. And basically things got out of control, and we ended up with a financial disaster. Fortunately for you and I, in 2002 and in 2007, there was enough government machinery. I'm not a big government person, but I can tell you that there was enough machinery in place that it prevented us from having the kind of depression that occurred in 1929. At that point, there was nothing in place to prevent what went on. An example might be that, as you know, with the stock market nowadays, if the market overheats, the government is able to close it down. In other words, the New York Stock Exchange, which is the largest and maybe the largest in the world, the government can simply close them down, just be shut down, no more business today. And the whole idea is to quell the panic that can come about when everybody feels like the economic system is going to collapse and they want to get anything they have of value out of it as fast as possible. So in 1929, there was no such thing. And in 1929, in October, I think it was 28th or 29th of that month and year, the market just crumbled. I mean, literally imploded into itself. And billions and hundreds of billions of dollars of value just disappeared into thin air. And companies that had any kind of assets and whatnot, the assets became almost worthless. And literally, at some point in time during this depression, American unemployment was in the neighborhood of 25%. Now think about that. We had our unemployment here has been, I think, 10 or 11. Normally, unemployment in this country runs about 4 to 5%, and that's considered to be relatively acceptable considering all the factors that go into employment or unemployment. But in this setting in 1929, unemployment from 29 up through the early 30s got as high as 25%. 1/4 of the workforce was without work. Now that meant 1/4 of the workforce, which had families and children and homes and in some cases a lot of small businesses, all just went away. But back to the stock market, what became apparent in the stock market is there were so much fraud in the stock market. Uh, People would make things up and say this is going to be the next great business, and here's 10,000 shares of stock, and we're telling you this stock's worth 10,000 a share, so give me your 100,000 or your million, I guess it is. And people were investing on that basis, but things were going so strong that no one sensed anything wrong. No one really could understand that people could be as dishonest as it turned out they were. And the result was is that the market just imploded. And things that were supposed to be of value weren't of value. Things that were supposed to be there, represented by the stock certificates, weren't there. It was all smoke and mirrors. And it just about destroyed the economy of the country at that time. Congress responded in the early 30s with two laws, which are the laws that are subject of my discussion today. One is the Securities Act of 1933, and the other one is the Securities and Exchange Act of 1934. So one after the other. Now, very briefly, the Securities Act of 1933 dealt with initial offerings of stock to the public. So initial stock offerings to the public and the registration required. And the concept, you can sum it up with the Securities Act of 1933, required registration of adequate information that a person could make an intelligent decision as to whether or not they wanted to invest. And to say it a different way, you were required to register with the Securities Exchange Commission, and the registration had to give adequate information with full disclosure. And the whole concept was full disclosure of anything and everything that you might need to try to assess the risk of putting your money into this investment, into this company, for example. And so the whole idea was full disclosure, all the material information we need to know to look at the risk and then make an informed decision as to whether or not to invest or not. That's the whole idea with the Act 1933, Securities Act of 1933. And in the Act of 1934, which was called the Securities Exchange Act, and the reason it added the word exchange is this was the statute, 1934, that was passed by Congress that actually runs the securities market, the stock and bond market and other related investment instruments that we call securities. So the Security and Exchange Act formed the Security and Exchange Commission, which we refer to as the SEC, Security Exchange Commission. And their job is to regulate all of the brokerage houses, the dealers, any firm or company that's engaged in the buying and selling of securities. And for our purposes of discussion today, we'll be talking about stocks and bonds. And I'll give you a little background on that in just a moment or two. So the Securities Exchange Act 1934 it created the Securities and Exchange Commission, and its job was to review all the registrations that are required under the 1933 Act and approve them or disapprove them, in which case they might send a registration back and say it needs more information here, it needs more information there. Their whole idea is to be the watchdog, that registration has enough information that an individual can make an informed decision as to what the risk is and what's the potential for their investment. And the other one is enforcement. And enforcement under the Securities and Exchange Act 1934 through the SEC is people who have manipulated or deceptively tried to buy and sell securities and in effect committed fraud. And on that basis, the Securities and Exchange Commission under that 1934 Act is empowered to pursue those people both civilly and criminally and to force them to disgorge any profits they made illegally, and in many cases send them off to jail where they clearly belong. Okay, so what is a security? A security is a lot of things, but for our discussion purposes, I'm just going to talk about stocks and bonds. You can have stock options, you can have stock warrants, you can have preferred stock. There's just a ton of different kinds of investment vehicles that are called securities. But for our purposes, in the simplest way, is to talk about stocks and bonds. Now, what are they? And quickly, we refer to stocks as equity, and we refer to bonds as debt. So think in these terms. In the world, there are huge sums of money called capital. Huge sums of money in the world. That's capital that's available for investment. And that investment can be, and the people that need the large sums of money, the huge sums of money, are major corporations throughout the world. They need to borrow that money to expand their businesses, to do more research, to prepare new marketing programs, to build a new device or a new piece of machinery, equipment that costs hundreds of thousands of dollars. So they need that money. So the way to get it is one of two ways. They can either borrow it, in which case they issue a bond. So they might issue a bond to me for $10,000, and they're going to pay me 6% on that bond, and that bond's due in 10 years. So I buy that bond, they have my $10,000, and they're going to use that money to do their research or to buy the machinery they need to build the device that they're building. That money is used for that. And usually with a bond, they pay twice a year, biannually, and every 6 months I'll get a check for 6% of the $10,000, or say $3,000, or I'm sorry, $300 if I get it every 6 months. Now, the other way for a corporation to raise money in what we call the capital markets, and the capital markets are really worldwide. People all over the world look to see what companies, it could be a company from Germany or wherever, are trying to raise money, and they're offering either to buy their bond or you can buy their stock. And when you buy their stock, you're buying equity. So it's like you're buying an ownership piece in IBM. Okay, for example, I have I think a couple hundred shares of IBM stock. Now there are millions of stockholders, but I am an owner still because I have 200 shares of their stock, and it's worth, let's say it's worth $100, so it's worth $20,000. Let's say, well, I own 20,000. I have $20,000 worth of value in IBM. I have some Microsoft stock, same kind of thing, a couple hundred shares. Again, $20,000 worth of ownership in that company. But remember now, they have millions and millions and billions of dollars of ownership money that's been put into their company by huge investors and by a broad-based group of investors from any of us might be there, or if you're in a mutual fund, they may own Microsoft stock. But in any event, when you take your money and give it to the company for stock, you now have equity in that company. If they go to liquidate the company, you're supposed to get your $20,000 back out if they sell the company. So if you bought the company and it totally was worth $1 million and they can sell it for $1.2 million, you get your $20,000 plus your share of which is an infinitesimal percentage point. It might be $23, but you get that also because that's the value of your interest in the company. Now with a bond, you have lent them the $10,000. You don't own any part of the company. You don't own any of its assets. You're just believing that if it'll pay you 6% on that $10,000 investment, you're willing to take that risk of having that money loaned to them that the corporation then takes out to use for growing its business. So those are the two sides in the capital markets in a very basic way: stocks and bonds, equity and debt. They have all kinds of other consequences that I won't get into, but that's what. So when a public company goes to raise money, it has to put together a registration statement for the SEC. The Securities and Exchange Commission oversees, supervises, and monitors how companies either offer stock for purchase by the public, which is an equity situation, or how a corporation puts a prospectus out and an offering to buy bonds. They're offering to sell bonds in their company for X number of dollars. Now, if the risk is high, very high, then the interest rate may be 12 or 15%. If the risk is very, very low, then the interest rate might be 2, 3, or 4%. It just depends. It's set by the risk involved. But the Securities Exchange Commission looks at the offering. It's called an offering. So it can be a stock offering or a bond offering. It can be a stock offering or an offering to buy equity in my company, or it can be a bond offering, an offering for me to pay you an interest rate to borrow your $10,000 until I'm finished with it or what have you. Okay? And the SEC looks at that and to see whether I'm giving you adequate financial disclosure for you to determine whether the risk is worthwhile for you. Now, the registration has to be done before the sale. It's a registration statement. It's an SEC form. It's 5-10 pages long. It's fairly lengthy. Invariably, a company engages an investment banking firm, lawyers, and accountants to put together this offering. It's a very complex, sophisticated kind of thing. And then they put it out there into the public marketplace where the Solomon Brothers, the Goldman Sachses, the Bank of Americas, all the big financial institutions see these offerings. The mutual fund companies see them, and then they decide whether they want to take some of their people's money and buy these offerings, be they a bond or be they a stock. Now, you can go ahead and skip over. We're about page 630 now, 630, and there's a bunch of stuff there about registration statements, what needs to be in the statement, and all that sort of thing. And you need not worry about that. That's nothing to be real concerned with. It's more than you need to know by a long shot. And since there's no quiz, I shouldn't say that because maybe you turn me off right now. I don't know. Hope not. Because I've got a couple of other things I want to go over with you by the time we get finished that I think are of interest to you. So hang in there. And I know I always promise it's going to be short. And then I get all excited about a topic and short, I forget about the word short. In any event, let's go to page 631 if you're following along in the textbook. And in the left-hand column, there's in bold print, it says exempt securities and transactions. So basically, the way the Act works, let's focus on Securities and Exchange Act. Both acts, in any matter, are dealing with public companies trying to either raise money by selling equity in their company through stock offerings or raise money through offering a bond, which is a note and a loan. Now, these statutes apply to these kinds of companies. They apply to companies that have more than $10 million in assets, and more than 500 shareholders. So a company that has gone public, so you can have a company that's gone public that has only $8 million or $5 million in assets and only 300 shareholders, and they're not required to meet the requirements set forth in the 1934-1933 two laws that apply, the securities laws that apply. It's got to be a company with 10 million in assets and plus 500 shareholders. And the idea here is that means it's not really broad, because a company like Microsoft, I haven't looked, but I think they probably have 10 million shareholders. I mean, major companies have millions of shareholders. Little companies will have a small number of shareholders, 5,000, 10,000, whatever. In this case, any company that's that small, under 10 million in assets and under 500 employees, shareholders, is viewed as can take care of itself below that. It's a smaller company. There's less likelihood that the public can be bamboozled. And if they get bamboozled, it's less likelihood they can get bamboozled for hundreds of millions of dollars. It might be a few thousands and so forth, in which case they go down and see their favorite lawyer and they bring their own private civil lawsuit against somebody that defrauded them out of their money in an investment. And by the way, that keeps the average lawyer busy most of his practice, because there's a whole lot of that going on all the time. So that's just part of it. But in any event, so the Securities and Exchange Acts and the commissions have seen a need to have some exemptions from the securities laws. In other words, here's the thing about securities, buying and selling or offering securities. It's extremely expensive, and it takes a long time. You have specialized lawyers that do the equity stock offerings, specialized lawyers that do the bond offerings. You have investment banking firms that crunch all these numbers and the financial information to determine what the number ought to be. Should they put a bond offering out for 100 million? Should they put it out for 50 million? 200 million? Shall the bond be a 10-year, 20-year, 30-year bond? Should the interest rate be 7, 8, 9, 10%? Should it be callable, meaning a company puts a bond out for 10 years at 6% and interest rates drop to 3%? Then you don't want to pay 6% for the next 5 or 6 years on it, so you call that bond. So people have to give you the bond back. You pay them off. You meanwhile go out and borrow the same money for 3% and save the difference. So All those factors go into a bond offering, for example, and that is done by very specialized attorneys, CPAs, investment bankers, and a whole lot of them. A registration like that can be 50, 60 pages long. It just takes a long time. Smaller companies haven't got the time, the resources, or the money to do that sort of thing, the people. So you have these exemptions, and one exemption is called Regulation A, and it's for small companies who do want to try to raise money in what we call the public markets. That is, they want to be able to make an offering out into the public through brokers and dealers about their stock, but they can't afford to go through the lengthy registration that's required of big public companies. They don't have the people, they don't have the money. So under Regulation A, if your company has less than 25 million in revenues, in other words, less than 25 million in sales, it's not asset sales, and your offering is under $5 million. So you want to raise something under $5 million, and within a 12-month period, then you don't need to go through all the registration processes that are found in the statute that large major companies must go through. So you're able to avoid doing that. And obviously the reason is, let's help out the small companies that haven't got those kinds of resources. And when you look through the text here through page 631 and on through, you'll hear it. They make references to rules 504, 505, 506. Not important that you know what those rules are all about, except to say those are part of the rules of exemption. Regulation A allows for the avoiding all these very sophisticated and lengthy registration procedures that the two laws require, and to make it much more simplistic. And 504, 505, 506 do the same thing. They're just other separate little categories that I don't think it's that important for you to know, except to know the term private placement, because you may well find yourself coming into contact with what's known as a private placement. We also call them a PPM, private placement memorandum. I've done a few in my day, and what they are is, it's a company that's trying to raise money. They don't want to register with the Securities Exchange Commission, and so if they're not going to sell it to the public, meaning putting it out into the public markets through brokers and dealers, but they may just be going to sell it through people they know, through a network in their industry, and they're trying to raise money, then under 506, they're permitted to do that with a private placement exemption, which we refer to as a private placement memorandum. Okay, and so that's permitted, and part of the idea is that you can't go touting this stuff out to people who don't have any knowledge of investments. So the idea is to try to protect the public from being boondoggled into some investment. With private placement memorandums, you're supposed to qualify the potential investors. They're supposed to certify to you now. So if they want to lie on their certification of their eligibility or qualifications, that's up to them. Then, who do they have to blame? But basically, you're supposed to qualify them that they've got over $250,000 of net worth, and that they know a little bit about investing. It's the bare minimum, but at least you're having to ask the question before you show them the private placement, and they have to sign it. If they don't sign the certificate or qualification statement, then there's no harm, no foul. If they do, and they decide to invest $50,000 in your private placement, then fine. If they lose their money, they lose their money, and it happens all the time, because these are little tiny investments, and you have to know what you're looking at when you make those kinds of investments. But the Securities Exchange Commission has decided there are literally tens of thousands of those kinds of transactions going on versus one or two major bond offerings that are going on. Or you may have 100 bond offerings in the process through the major corporations in the United States, and they're going through the process of coming out into the public markets, which means to the Merrill Lynches and to the big brokers. In the meantime, you've got hundreds of thousands of little deals going on, where a friend of yours is trying to launch some kind of business. He's trying to raise $100,000, and he may have a private placement memorandum, which has usually been prepared by an attorney. It's a much shorter document, maybe 10, 20 pages long, describes the investment, describes the company, tells what the risks are, and then the person signs the qualification statement, and they may invest 10,000 or 15, and he gets himself 10 or 15 investors, and off he goes. and they have this private placement memorandum, and that tells them what they're getting into, and then they get a percentage of the stock, and they own the stock that way. But it's a security, but it's not required to be registered through the SEC. Okay? Now there's another Rule 144. So all I care that you kind of keep in the back of your mind or have exposure to in the course here is that the Regulation A is for small companies under 25 million in sales, and they can raise less than 5 million without having to register, save all that money. And then the other exemptions are 504, 505, 506, and 506 deals with these private placement memorandums, which allows small little ventures by people like you and me who have an idea or have a partner, see something we think can make money, we're trying to raise money, and so we offer the private placement memorandum, which is the prospectus. It tells you what's there, what the company does, what its market is, what it plans to do. It'll have financial statements in it. It'll have financial forecasts in it, and it'll tell you each unit, if you want to buy 5% of the company, that unit costs you $10,000, and that's how they do the private placement. Now, the other one is, the last one is Rule 144, and we call it Rule 144 stock, and I'll just hit it very broadly, so to speak, simplistically. And basically what it says is, this is, Rule 144 deals with reselling the stock. So in other words, someone has already bought the stock. It's not an initial public offering, an IPO. You've probably heard that term, an initial public offering. It's not that. This stock has been sold, and now it's paid. You're capable of reselling it. And if it's 144 stock, it has certain restrictions on its sale, one of which is you have to hold it for at least 6 months. So the stock has to be held for 6 months before you can sell it, resell it, so to speak. Now, to give you an example that I'm sure you probably are relatively aware of, is Facebook went public maybe a year ago. Now, I'm not sure how long ago. Now, when they went public, they were offering shares of stock. So they weren't borrowing money. They weren't offering bonds. They were offering stock, your chance to buy equity into Facebook. Now, everybody knows what happened to Google, and they went public, and their stock, I think, it went off at, I forget now whether it was $50 or $100. Most stock goes off at somewhere between $15 and maybe $25 a share. Most initial public offerings of a company that looks like it's got some future come in around 10, 12 to 15, 18, $20 a share. Okay? But when Google came out, I think it came out at 50 or something like that. It's now, I think, $700 or more a share. I mean, it's an enormous return on investing $50 or 35, 40, whatever it was. And so along came Facebook, and the play Facebook got. Everybody was so excited. We're going to make a fortune. It's another Google. You hear that all the time. It's another Apple. Apple had gone to 500 and 600, and now it's dropped back a little bit since Steve Jobs died. But this is the idea, the excitement and the hysteria of it all. Okay, so what happens is Facebook goes out. When I say go out, it means their initial offering. If you wanted to buy a share of Facebook, you had to pay $35. Or was it 30? I think it was $35, I'm pretty sure. It went out at $35. Well, first of all, you need to understand that on these initial public offerings for the big companies, you and I can't even get in the ballpark, okay? We have to watch it on TV because Wall Street and the big money institutions are already in the ballpark. They're already in uniform, and they're already going up to the plate, and you and I can't even get inside the stadium, okay? It's for the big players. The IPOs are for the big players in this respect, and that is the stock, they take subscriptions before the day it's going to go on the market to sell. So basically probably 30 to 60 to 90 days before that, the people who are putting out this stock offering by Facebook have already talked to Goldman Sachs and Solomon Brothers and Merrill Lynch and Bank of America and all the rest of them that are in the broker-dealer stock selling business in huge blocks of shares, 100,000 shares, 50,000 shares. And they have already subscribed to this offering, meaning they've signed up and reserved, if you will, 2 million shares for them, 5 million shares for them, 10 million shares for them. I forget what the first Facebook offering was, but I would probably suspect it was 200 million shares, maybe more, but it was a huge number, huge number. You can see why you and I can't get in there and buy 100 shares. I mean, okay, so 100 shares is what, 3,500 bucks? Or no, 100 shares? My math's bad. It's 350,000. Either way, you got to come up with 35 grand or 350,000 to buy your 1,000 shares of stock of Facebook. In any event, the stock was offered at 35, snapped up by everybody. Okay. Uh, and boy, this is bothering my memory now, but I'm going to say it went out at 30. I think it went out at 30. Well, let's go 35 for my example. I'm sorry. And the next thing you know, the stock closes at about $36. Now, most of these people that have been doing this for years, the boys on the inside, the Wall Street crowd that knows, they know the game better than any of us. They're expecting that stock is going to skyrocket to $200-300 a share by the end of the day, certainly by the end of the week. I mean, they're expecting, people are screaming to get a piece of this action, and it's all sold out. And when I say all sold out, it means if they were going to put 100 million shares out, it's all been claimed by people who have pre-subscribed, which is legal. Okay? And so what happens is they go out, and as soon as the gong sounds and the stock's on the market, these transactions are getting filled. They're getting running through right now, and the money's going, the stock's coming, the money's going, the stock's coming. So at the end of the day, the 100 million shares have gone out. They've recouped 35. Let's say they've recouped, and I'm just going to work with me on the numbers here. Let's say they got $350 million off the sale of 100 million shares of stock, whatever the number was. So they got $350 million. Facebook now has that money. Now, there's a number of huge fees and so forth that are involved. So maybe they're going to net 330 million or 310 million, but they've got over $300 million now. And all those people out there in the world, which are really represented by the brokerage houses and firms, now have the 100 million shares. It's been divvied up among all the people. Mutual fund companies may have some of it, whatever. But what happened with Facebook was the stock didn't go like that. The stock only went up $1 or $2, very little. Not only that, within a week or two, the stock fell below the offering price, which is almost unheard of. So it went down below $35, and now guess what? You paid $35 for a share of that stock, and now it's worth 31 bucks. Guess what? You just lost $4, right? Now let's suppose you bought 10,000 shares. You lost more than $4, right? Like maybe 40,000, right? In a week. You're not very happy. The big players were real unhappy because they lost millions. On paper, they had paid X dollars for $35 share stock, which was now worth 31, and they had bought 5 million shares or something. And so they had just sitting there looking at a $4 million loss, huge losses. Well, those guys don't like to lose. So, of course, what they do then is run down to their favorite little lawyer, big-time New York lawyer, and they now turn around and sue Facebook for misleading information under the securities laws, for misleading the public as to what the value of the company was. It's nothing but sour grapes. They're greedy as can be. When it didn't play their way, now they want out. They're all screaming and whining foul. All right? Now, all that background, maybe it's interesting to you or not, because I have Uncle Clay has a tidbit for you on initial public offerings, but before I do that, a lot of this stock went out to employees under what's known as the 144 restriction, which meant they had to hold it for 6 months. So a lot of them got stock options because they'd worked for Facebook for a long time. And with these options, they didn't have to pay $35. They got this. A lot of it just gave them stock grants. So in effect, they got, Facebook set a large chunk of stock aside to give to their employees as part of their. You have a stock option, you can exercise it at $2, or you can exercise it at $5. But out in the marketplace, it's going for 35. Okay, so you got your shares. So now people have these shares. Well, 6 months later, they can't sell them in the first 6 months. Now, in the meantime, Facebook shares went down below 20. Now think about that one. You paid $35 for 20,000 shares of this stock, and now it's down below 20. So even say 20, you lost $15 a share times 10,000 shares. Do the math, right? Big number. And now, a little investor could buy 3 or 4,000 shares after the first week or two. You could probably pick it up. But now, maybe you're buying it at 25. Now it's down at 18. I think it's now 18 or 19. It might have gotten to 20, but it dropped as low as $18, which is almost half of what it went out. The offering price went out for. Okay. Lawsuits all over the place. I don't know if they're still out there. I listened to a very respected analyst who, because it is a certain inexact science of determining how much you should price your initial public offering at. And in his opinion, it was $9. He said, in his opinion, that Facebook's value of the Facebook company, if you wanted to buy a share of their stock, was $9, not 35. And people who know the game well, in hindsight, of course, said that this stock definitely should not have been $35, but it was all hype. It was all hype. Apple's going up like a rocket. Google is, people look at Google, they look at Facebook, they see the same kind of thing, and up it goes. And so the expectations drove it, where it probably should have gone out at $15 a share or $18 a share. But expectation and hype and the other things that go on around the market with an Amazon or a Google and their price shares going up and up, they kind of put Facebook with Google and Amazon, put them all together, and they're completely different businesses, by the way, completely different business models. And the stock went out at 35. Now, why did it go out at 35? Because investment bankers, because lawyers, CPAs, financial people all also got caught up in it. And they did all this analysis and this other mumbo jumbo with their computers and financial models. And, what does Zuckerberg care? He's going to make billions, so what does he care? Put it out there. I don't know. As long as they can get it sold out, which they did. There was so much hype, right? Zuckerberg became worth $19 billion. When they opened for business at 9 o'clock on a Monday morning, when they closed for business at 4 o'clock or 2 o'clock, whatever time it is the exchange closes, at the end of Monday, he was now started being worth, who knows, 2 or 3 million with the company. He's worth 19 billion, okay? And do you think he really cared if the stock went out at 35 and closed at 30? What does he care? He didn't, this is all blood, sweat, and tears. It's not, you took your hard money out of your pocket and plopped down $35 a share, and now your 35 is gone. It's only worth 30. You're not a happy camper, right? Anyway, so at the end of 6 months, then you can then sell your stock. So they had to be very careful about how you sell. The company is very concerned about people selling their stock after the 6 months, because stock is a law of supply and demand, in addition to people's view of the company. And so in that setting, like a guy like Bill Gates, who's had Microsoft public stock for 25, 30 years, he still sells a little bit at a time, because if he dumped he supposedly has something like 300 million shares of stock still left. If he threw that all in the market, the stock would go from $25 to $2, because this law of supply and demand. So you have to put it out there a little bit at a time. Well, there was tremendous concern when the Rule 144 stockholders, who were mostly employees of Facebook, were reaching that 6-month period, because the stock had not performed well, and they were worried they were going to dump it. And if you got thousands and thousands of shares being dumped, again, supply and demand, price goes down. Now the stock is down to 12 or 15. Okay, how does that hurt the company? It hurts the company because a lot of the loans it may have had, a lot of the results it was looking for, now your company's not worth $5 billion. It's worth $3.9 billion, because all this other value came out of it because the stock price collapsed. So that is how the 144 works. Now, the little tidbit I'll give you is, my advice is, people like you and me can't get into an initial public offering unless we're Zuckerberg, okay? In which case, ignore what I'm telling you. And I doubt very seriously you'd get much into the chance of doing it, but certainly this holds true, this premise. The smart boys on Wall Street, on all these IPOs, usually have all the stock bought before you can touch it anyway. But let's even suppose you can get a hold of it. Classically, what happens is the stock goes up. and quickly because of the demand, the excitement, the anticipation of this company, whatever it might be. Very often it's with a company with a new drug is a good example. And so the stock is offered at 15. People are buying it. It goes to 20. A week later, it's at 23. 2 weeks, 3 weeks later, it's at 31. A month and a half later, now it's at 40. So it went out at, say, 15, and now it's at 40. Okay? So you went in there and you bought it at 21 or 25 or whatever. Invariably, what happens is after the hysteria, after the excitement is over, which usually is anywhere from 60 to maybe 180 days, but usually about 3 to 4 months, and the stock now starts to settle because all that air, all that hot air excitement, all that anticipation is gone, and we're back to reality. And it's like after the honeymoon, now we got to learn to live together. So after the honeymoon, now the company's got to sit down and figure out how do we make money and how do we make this company profitable. And the next thing you know, the stock goes down to 20 and 18 and 17, and it may very often they settle below the offering price of 15, settles down at 12 or 13. Now, have you lost money? Well, on paper you have if you don't sell it, okay? But it means then that you're going to have to hold that stock for a while to get it back to the 22 or 3 you paid for it. So my point is, we're not IPO people, meaning you and me. At least I don't think so, unless we're Zuckerbergs. You don't want to run out there and try to buy into an initial public offering unless it's your own company, because you're going to get hurt. It's the classic way, and that's why these guys on Wall Street were so ticked off about the Facebook deal, because they figured at 35 they're going to buy all this stock, which they did. And now the next thing they know, take their 6-month holding period, if any of them had the Rule 144 holding period stock applicable to them, then they figured, well, what the heck, in 7 or 8 months from now, this $35 stock that we bought is going to be worth $400, $350, just like Google, just like it happened with Google. So we'll just, in 7 months, we'll just make millions. Guess what? It didn't work out that way. They lost millions. And so therefore, of course, it's got to be the lawyers, it's got to be dirty Mark Zuckerberg, and all these people lied and cheated us. It's all it's the way the game's played. The SEC oversaw what they put out there. The SEC approved it. They sold the SEC on what they were putting in their offering, and guess what? A bunch of hype, and it didn't turn out to be real. And as a side note, in talking to a lot of my young students in some other classes, I asked them about Facebook, and I said, what do you think about Facebook? Because you're investing all that money in a company. How's that company going to grow? What's really its business? It's a social network, but what's its business? And most of these are based on advertising. When you look at the business model, the kids would say to me, well, you remember, not YouTube. Now I'm not going to be able to remember it because it's on the tip of my tongue. MySpace. So you remember MySpace? He says, no one looks at MySpace anymore. Well, MySpace to me was kind of analogous to Facebook. And I said to them, what about your Facebook thing? Well, it was a lot of fun when we first got on. It was kind of cool and neat. And I know a lot of people like it, but not maybe the millions that you would need to like it to keep the value of the company up like that. And so you have to look at it and say, is this a real business that can grow and develop into something like a Google has? Or is it just a fad? And is it going to disappear in another 3 to 5 years because it can't keep a business model that's profitable going? So again, that's made me wonder about Facebook. So if you remember Facebook, enjoy it, but don't put your money in it. I guarantee you're going to be really sorry if you do, because I don't see a business model that is going to last very long. Okay, now violations of registration. If there's a violation of a registration, you have a couple of defenses, and here they are. So in other words, you put out a registration, someone says it's false, and they come after you for it. Your defenses are, number one, that whatever the statement was you relied on was not material. So in other words, someone's made an investment, they put their money in to buy your stock, and the company has problems, either unexpectedly or what have you, but certainly you haven't intentionally tried to cheat or steal anybody, but the stock just didn't take off. In that setting, if you can show these 3 defenses: 1, it was not material, whatever that representation was not material. Number 2, that the buyer, the plaintiff, who bought the stock, he knew about the statement, and he either had a chance to check it out further, or he knew that it wasn't correct, and he bought the stock anyway. And believe me, that happens. And the last one is that you, as the company owner, let's say you're the Mark Zuckerberg, and you work with your lawyers and the investment bankers want to put the stock out there, and you do what we call the due diligence in putting together all the information that you think is accurate, allows an investor to look at it and say, if I buy into this business model, then I think this is a company that's got value. I don't think I'm being lied to necessarily. I'm going to put my money in and I'm going to buy it. Okay. Now that's probably the big place where the Wall Street whiners came after Facebook, where they said, the due diligence wasn't adequate, they didn't have enough information, the information they gave us wasn't quite right, and then in number one, they'll say, oh, this was a misstatement of a material fact, they knew or should have known, and it's all the lawyering back and forth and the jousting, and the whole idea is just can we get some leverage on them and make them settle with us and give us some of our money back. Basically, legal sour grapes, I call it. Okay. Okay. Now the Securities Exchange Act, 1934. What it does is it requires and regulates exchanges. Okay, it regulates. Well, you have to work on stock exchanges, but primarily the Securities Act of 1934 created the SEC, Securities Exchange Commission, and it regulates the exchanges. Now, what are the exchanges? The two big ones that you've all heard of is the New York Stock Exchange and the NASDAQ, which stands for National Association of Security Dealers. And I think they put a Q on the end of it because I think it's called the National Association of Security Dealers Quotation System. So we often see it as the NASDAQ or heard it spoken about as the NASDAQ. These are the two major stock exchanges in the country. And for a long time, many of the tech stocks were on the NASDAQ. They weren't on the New York Stock Exchange. But they do basically the same thing. The whole idea is the same thing. So, for example, on the New York Stock Exchange, or you could have broker dealers like Goldman Sachs or Citigroup, their investment arm of the big Citigroup banking operation. A little smaller one would be Edward Jones. There's a little company called Edward Jones, and they're kind of like they'd be like someone for me. The little guy's got a little money, wants to invest in the market. They have little storefront offices. They're very nicely appointed. The people are fairly well trained. I don't know whether you should give them carte blanche on an investment, but they certainly can do research for you and give you some advice. And then you buy the stock through them and they make a commission. But those are the little brokerage houses. And then you have even smaller than that, where you have one or two people who are brokers or dealers in the buying and selling of securities, which they then buy through a larger clearinghouse operation, which might be a Goldman Sachs or so forth. Okay. As I said, Securities Exchange Commission and that law, 1934, applies to companies with assets over 10 million and more than 500 shareholders. Okay. Now here's the big thing. Under the statute, you are required to file what's known as a 10K. So every public company must file a 10K every year at the end of their fiscal year, which will usually be, it can be June 30th, which is the end of the second quarter, or it can be September 30th, which is the end of the third quarter. Very few of these large corporations have what we call a calendar year end, which is December 31st. All small companies, if you're a sub-S corporation or a small company like that, not a public company, your year end is usually December 31st, so it dovetails with the end of the year. But large corporations tend to have them not on the calendar year basis. And so in this case, your year end might be March 30th, it might be June 30th, it might be September 30th. Okay. So under this act, if you're a big public company, you have to file a 10Q, the Q for quarterly. So every 3 months you'll file your 10Q, which is your financial reporting of all your revenues, all your expenses. It breaks down what kind of machinery do you own, what kind of real estate, what kind of loans do you have, how much is your accounts receivable. I mean, enormous numbers, of course, if you're talking about an IBM or a General Electric or someone like that. But you have to do these financial statements every quarter. And what happens is the Wall Street analysts look at that and decide what they think about the performance of the company. Is the company performing well or not? And if not, why? Okay, and then they sell that advice to the public or to other brokers and dealers to help advise their clients what to do in terms of their investment. And then the big one is the 10K, and I assume the K, I always use K as a demarcation of 1,000, 1,000. You'll see this one cost me 5K, that one cost me 10K. It means 5,000, 10,000. And so they use the word K for like an annual full year kind of thing. And that's the big one, the 10K. That's the entire year's operations. And that's the one that all the financial analysts really look at big time. Okay, now, the major enforcement rules, and just generally know what the numbers are, but I don't think you will have heard these numbers, these rule numbers or section numbers. There's section 10B and there's section 10B5. And these rules deal with manipulative or deceptive activities or conduct in the sale of securities. So 10B, 10B5 deal with where people have manipulated or deceptively engaged in activities to sell securities and basically committed fraud. So those are the two enforcement areas. And they deal with things such as lack of full disclosure. The other one is insider trading. So they deal with insider trading, and what insider trading tends to be is it's officers, directors, and often major shareholders who have access to information that is not available to the general public. So that's the whole idea behind the SEC, and it's what it does is to, at least in the mind's eye of the public, that it's a level playing field, that you can't trade, someone else who's on the inside can't make money off the stock, and you're going to go out and buy it and lose money because they made all the money when they bought it because they knew what was going to happen. One of the bigger areas is where the directors or officers find out the company's in big financial trouble, and it's got all kinds of problems. It's lost big customers, and this and that, and nobody knows that yet, but they know it. And so they've got a stock worth $30 a share, and they know it's going to drop to 20 or worse. So they run out and sell their stock before the report gets filed, before the 10K gets filed. Well, they go to jail for that now under the Securities Act. Before they didn't, and it happened all the time before the Securities Act came in 1934. So the question was, who were you dialed into? Who was your contact? Not anymore. The SEC, and you'd be surprised how well the SEC, how they catch people. I mean, I had some clients, or clients who had a friend who I found out about through them, where they did little deals they found a tip from somebody that was on the inside of something, and they made themselves $40,000 or $50,000 or $30,000, and the SEC caught them. And don't ask me how. I don't know how they caught them, but there's ways they catch them, and I'm sure with automation and what they have technologically database now, they probably a little machine that spits stuff out that's suspicious. But it's things like the stock sold for 30. The guy bought the stock at 30. The stock went up to 70, and he sold it, and he kept it all in 3 days or 2 weeks, whatever it might be. And something in that little database says, ding, rings the bell, and the next thing you know, they're called up and they send out the FBI to come talk to you. It makes for a long night's sleep. So in any event, they do catch them, and they catch them under 10B and 10B5 under insider trading. And the key to know about insider trading is it's someone on the inside, officer, director, shareholder, and they have access to information that the general public does not. And generally what happens, and I worked for a public company at one point at the highest levels. I went to the board meetings. I heard these discussions about things the company was doing, many of which could have a real bearing on what the financial results would look like, and I was under absolute oath to say nothing to anybody about it. The information would be published the next day at 8 o'clock in the morning. It would go out on what they call the wire. The Wall Street would pick it up. The Wall Street Journal would pick it up. The newspaper would pick it up. And once they picked it up and printed it, in fact, once we put it out to the Securities Exchange Commission, then it was now viewed to be out in the public realm, even if it was 3 minutes old. And then I could tell somebody about it. But at this point, you can't say a word about it because you have knowledge that others don't. And the whole idea is hopefully the general public is not going to get taken advantage of that way. That doesn't, however, belie my jaundiced, cynical attitude about the fact that the guys on Wall Street know what's going on, and they do. And whether they get inside information, I don't know. I'm going to guess somehow they find out. But they are, let's put it this way, they're more apt to know than you and me. And so they make tons and tons of money, and it's an insider's game as far as I'm concerned. And I don't know if any of us will ever have the kind of money we can afford to play in that game, but in my mind, you better have 50 million at least to even try to get near the front door of that game. That game is a $100 million and up game. But in any event, it is an effort by the government. It is an effort by our country's government to try to level the playing field as much as they possibly can for the public. Because if everyone was as cynical as me about it, and then none of us would buy any. What we wouldn't do is we wouldn't put our money in a mutual fund. If a mutual fund had a couple of companies that we thought were a bunch of crooks, and we wouldn't put our money in there, even though we're in there with a bunch of other people. Why do I want to get on a lifeboat that's sinking? So they really do have to try to have us feel a certain amount of comfort. And what you and I do, I think, is we then give our money. If we give our money to somebody we know, and I have a fellow who manages some savings that I have, but I know him, I trust him, I know how extensive amount of knowledge he has in finance. He taught finance at one of the universities here, young fellow, smart. And so he's not going to know as much about the Wall Street guys either, but he can read the tea leaves better than I can because he does it for a living. He does it every day. And so people like that this kind of thing helps them a lot. It helps level the playing field for me through him, if you will. And so it never hurts to have somebody help you with that. Okay, now let's skip from page 635 to page 637. How am I doing here? Okay, a little lengthy maybe, but this is another area that I have a great deal of interest in and get a little fired up over, so bear with me. Maybe I'll have a story or two in here you might find interesting. Although I'm sure you can tell from the smile on my face that after all these years, and I've been around a long time, I really have to tell you I got a certain amount of satisfaction out of watching these Wall Street guys get their clocks cleaned on Facebook, because they deserved it. And in any event, okay, let's go to page 637. Let me get over there with you real quickly here. 637. Okay, here's 637. Okay, and 637, and what I want to talk about is what you see here, the Private Securities Litigation Reform Act, and the Securities Litigation Uniform Standards Act. Okay. Now, remember that under 10b and 10b-5, those would be the laws under which you would sue the issuer of securities or the one handing out financial statements or financial information in your 10Q or your 10K. That's who you would sue if you said they were providing you with misleading financial information under 10b, 10b-5. That's through the Securities Exchange Commission. That would be your lawsuit. That's who you'd sue for it. Okay. Now, we also have something in the U.S. law that we call, you may have heard, class action lawsuits. And here's how class action lawsuits work. And they're germane to this situation and these two laws that I wanted you to just take a peek at. Let's say, well, I can remember one, for example. It was FedEx or United Parcel Service. And when they were calculating the cost to mail something, they were somehow rounding up the number to charge you to another number or two above. So the net result was the way they were calculating the charge to you was, and their calculation was controlled by federal lending laws. They were rounding up, so they were actually collecting an extra dollar or two on everything you mailed using their system. Okay, and this is more of an example. I think there is a UPS case along these lines, and this is what I want to talk about to give you an example of class action. And so let's suppose you found out about that, and let's suppose you looked at it and you said, I mailed 5 packages in the last year, and those son of a guns overcharged me $2 a package. They overcharged me for $10. And that really ticks me off. Well, so what are you going to get down to? You want your $10 back, and UPS says, well, that's the way we do it. So too bad, that's the way we do it. I mean, at that point, what are they afraid of? Little old Clay McQuitty who wants my $10 back because you overcharged me. could care less, right? Well, what happens is there's an area of the law called class action lawsuits, and class action lawyers are a group of attorneys who specialize in this kind of case. And here's how it works. And the initial concept of class action lawsuits was a good one. And my example is going to show you, you understand why it's a good one if you don't already know about class action. How can I sue UPS for $10? I mean, it's not worth it to me. No lawyer will take the case or whatnot. Well, what happened was I go down and talk to a lawyer who knows about class action, and I tell him what happened to me. And he says, well, when did this happen? I said, well, it happened 3 years ago, and it just recently happened the end of last year. So it started in 2010, 11, and 12. For about 3 years, I've probably mailed 12, 13 packages by now, and they charged me $2 extra that, and the law says it's supposed to be this. And the class action lawyer says, okay, let's see. So he says, would you be the lead plaintiff on my class action lawsuit? And I say, well, what's it going to cost me? And he says, it's not going to cost you anything. He said, because I've got to have a couple of named complainants, named plaintiffs. I've got to have a couple of individuals. And the individuals represent the class. Okay, they represent the class. The class is the group of people who are in similar circumstances as me, in the same setting, with all the same facts, who also got screwed at $2 a package. Okay? Now that doesn't sound, okay, so where does that take me? Well, here's where it takes you. Now instead of having me and maybe 3 other neighbors of mine that I know, these guys file their lawsuit, they file a motion with the court, and they ask for discovery, and they want the name of every single person from January 1st, 2009, or 2010, to December 31st, 2012, who mailed a package under these situations and circumstances using UPS. Now, let me tell you, when UPS gets that notice, I can tell you a lot of people don't sleep well that night. A lot of people rush to the men's room because it turns out that there's 5.5 million of us at $2 a package. 5.5 million people. And the next thing you know, UPS finds themselves looking at a $3 billion lawsuit under class action. So now all of a sudden, little Clay with his $10 claim, turns out now there's 5 million people who got screwed by UPS, and I got overboard with the number, but let's just say 500 million. $500 million when you take those millions of packages at $2 a crack, and now you got a lawsuit, and now you're going to get somebody's attention. And the concept with it was a great one because companies would do that kind of stuff to people. And you kind of say to yourself, you got to be kidding me. Well, in reality, the answer is yes, they do. B of A is one of, and I will first caveat if I haven't already said it to you before. I think B of A is run by a bunch of scoundrels in my mind. But B of A was caught in a class action lawsuit where they changed the buttons on an ATM machine, at least as it was told to me. They changed the buttons on an ATM machine, and a button where you usually put your number in and you press the button to get your money out and whatnot. They moved that button to another location on the face of the ATM machine and instead put in the button that where everybody had been pressing forever. That's what, it was automatic, right? Put it in, press the button, out comes your money. That button then printed you a little statement, like a little ticket about that big, like you get at a restaurant or whatnot, right? And it tells you what your balance is in the transaction. Well, you don't care about that. You don't want that, right? What do you want that for? So you look at it and you throw it away, right? And you take your money. Guess what? How many people look at their bank statements? Not a whole lot of us, not like we should, me included, right? They were charging $1 for every one of those little receipts. Okay, so let's say they go to the ATM twice a week. So that's $2 a week. That's $104 for the year. If I go twice a week for a year, it's $104. What's that? Nothing. How about 10 million people going to B of A for a couple of years, getting their ATM money and getting charged $1 for that little piece of paper? And they caught Bank of America doing that. And we talked about ethics, and you say, oh, those rats at Bank of America. Let's stop for a second and think about this. Somebody had to come up with that idea. Somebody had to hear that idea presented to them. Those are people like you and me. And they had to take it to some kind of committee because a company as big as Bank of America has, you don't just do this one person. My guess would be that this went all the way up to probably the senior VP for marketing, perhaps. Whether it went to the chairman of the board, I don't know. Whether it went to the CEO, I don't know. But it went pretty darn high into Bank of America, which has about 50,000 employees. And so individual people, talk about ethics, individual people decided that they were going to stick it to their customers to make a buck a piece on those little slips of paper. And that's why class action lawsuits make sense if they're properly motivated and for the right reason. And Bank of America got nailed for about 40 million or something like that. As well they should have. It should have been more. Okay. But the thing that riles me is that those decisions, you read them in the papers, oh, that Bank of America, what a bunch of rats. Guess what? They're individual rats. They're people that may look like you and me, meaning male, female, my age, your age, what have you. And they sat there and consciously decided they were going to stick it in our ear. And it happens all the time in various places in American business. And that's why you got to root it out. And I tell you that, and I'm pretty much a capitalist guy. I mean, I'm pretty much a fair market guy. I'm a free market guy. And that kind of stuff, there's no excuse for it. You can make a good living. You can make a good profit running a company with good ethical culture and beat the competition fair and square. You don't have to cheat like this. But we talked about ethics and we talked about culture, and the company culture at B of A is not of the best quality in my mind, caliber. I'm way off the topic, but I told you I got get a little fired up over something. Anyway, so that's what a class action lawsuit is. Now, the other thing, I guess I do get carried away here. The other thing is there's the bar, meaning lawyers as a group, particularly in the litigation field, is polarized between the plaintiff's bar and the defense bar. And when I say that, the lawyers who bring all the lawsuits, the guys who are the plaintiff's lawyers, are one group called the American Trial Lawyers Association. The other side are the guys who represent, and the big firms who represent the big companies, big business and other big entities. These guys are at polar opposites of each other. Now, I'm going to generalize, stereotype a little bit, but this is not a stereotype. The American Trial Lawyers Association, right behind the education, or the teachers union, I forget what it was, the National Teachers Association, they were the two largest contributors to the Democratic Party. Okay, so American trial lawyers, plaintiffs' lawyers are the biggest contributors tend to be to the Democratic Party. The Republican side tend to be the defense lawyers, the white shoe guys, the blue bloods, okay, and they tend to represent the companies being attacked and whatnot. But like I said, there's good basis for class action lawsuits. There are good basis for a lot of personal injury lawsuits that are brought. Sadly, there are many, many instances where plaintiffs' lawyers are guys with some pretty poor ethics, and they bring lawsuits for just about anything, and you've all heard the term a frivolous lawsuit and so forth. And everybody tends to think, oh, well, they got this company or that company for something, and you think, well, that's the way it is. Guess what? The price is going to go up with whatever good or service you're buying from that company. Because if they had to pay a $10 million judgment against them for something that really was questionable as to whether they really should be liable for it, the price of whatever you buy from them is going to go up. They're going to eat that. They're going to add it to their price somehow. So when those kinds of things happen, it ends up costing everybody more money. So let's take that, our securities background we've had so far, sale of stocks and bonds, and class action lawsuits, and talk about these two statutes. Sorry it took so long to get there. Okay, these two statutes came about for this reason. In the 1900s, in the 1990s or so, and the leading guy was a guy here in Southern California. He lived, his firm was in San Diego. His name was Bill LaRock. Bill is in jail now. Bill made millions. He was a senior partner in a firm called Milberg Weiss down in San Diego. And here's what Milberg Weiss would do. They were class action lawyers. In fact, I read an article at one point where they had hit Orange County companies for over $1 billion in settlements. Now, most of these cases never go to trial, by the way. They never go to trial, which is where you do get this allegation of blackmail, but they don't go to trial, very rarely. So the companies settle them. But here's what Milberg, Weiss, and Bill LaRock and others were doing. A company would issue its financial statements, and it might also issue a forecast, and that's often done in the financial world because they're trying to raise money. They're trying to say this is what we're going to do. I'm sure you've heard on the radio where, Toyota stock came in at $1.20 a share in earnings, and the Wall Street thought it ought to be $1.30, so they missed their earnings because they forecasted and they didn't get there. Now, why didn't it get there? Who knows? Could have been all kinds of reasons. Could have been happened in 2007 and 8, and the recession came into place, and they didn't sell as much as they did. Could be the price of oil. There's 1,000 reasons that have nothing to do with criminal intent that can that cause a company not to meet its earnings projections. Okay. Well, here's what these guys would do. They first of all, this is what got LaRock going to jail, which is appropriate. He would go find. There was one doctor in Southern California here somewhere who was the plaintiff in something like 30 or 40 of these lawsuits that were brought by LaRock and his firm, and he would be a named plaintiff. So they would pick out a company that they wanted to get after with class action lawsuit, and they would send this guy out to buy stock. Now, he could just own 100 shares. He could own 1,000 shares. Once you own a share of stock, you're an owner of the company. And once you're an owner of the company, you're entitled to the protections of the Securities Act of 33 and the Securities Exchange Act of 34, which deal with full disclosure, no misleading financial statements, and so forth. Okay? So this guy buys the stock. Company comes out. I think the textbook says it too. So a company comes out and they project they're going to have $15 million worth of earnings in the third quarter. So their CFO gets on the conference call. They have these conference calls with all the Wall Street analysts and everybody who's going to report on the stock and whether they think it's a good stock or not. And then the pension plans and the mutual funds and so forth buy the stock for their customers like you and me. And so they put out a forecast that they would do 15 million in earnings at the end of the third quarter. Lo and behold, they didn't make it. They didn't get to 15 million. Let's say they got to 12 million. So they made good earnings, but they didn't get to 15. Well, what LaRock and his crowd would do would turn around and sue the company under 10B, 10B5, accusing them of issuing misleading financial statements because they would do the forecast, they would issue financial statements at the end of the quarter and say this is what our financials are, and if you add the 15 million in earnings, the next quarter should be this, and when the financial statement came out, it wasn't that, it was something less. Still made a profit, and he turned around and sued these companies, and there were literally hundreds of these lawsuits all over the country. Because the plaintiffs' lawyers, and there are good plaintiffs' lawyers and quality plaintiffs' lawyers, but there are also a lot of bums out there. And they're like flies on you-know-what, and they look for where they can make the most money the fastest, and they can tell you all kinds of crap about how they're looking out for the little guy. But let me tell you, I'll give you an example of the little guy, the class action lawsuit, and I've seen plenty of them. They'll sue somebody for $50 million, some big company. They settle it for $30 million, okay? Their fee, cash, is $10 million. Now you've got $20 million left, and maybe you've got 10 million people who are supposed to get some money, right? So each person gets a check for $31.20, and the lawyers get $10 million. Now you tell me that they're not going to, something like this doesn't look good to them? And what's the reality is? The reality is that the company can't be dead certain of everything. It's their best estimate using the financial people they have, using the marketing people. Everybody gets together and says, this is what we think we can do. Last year we did this. The year before we did that. Our salespeople tell us we have these deals in the hopper. Our R&D people tell us we have this new product coming out. We have this service. We've priced what we think the profit margins ought to be, but if they're not that high, we can still make a good profit with it. They put all that together and they say, here's our forecast. One little thing out of their control, and LaRock jumps on them and sues them for $50 million on a class action lawsuit, saying that they issued misleading financial information. Now imagine what that does to American business. Okay, so now remember, under these statutes, we're talking about disclosure, full disclosure. Okay, so now you have to ask yourself, what is full disclosure? All right, So now you and I are we're in the executive meeting together on our company, and we're looking at the things I just talked about, new products, new services, what our margins are going to be. How much of that do we have to disclose to avoid a guy like LaRock suing us for misleading financial statement? Because if we put all that stuff out there, then if LaRock goes to sue us, we can say, yeah, but see, I mean, look what we talked about in our margins, and if this device gets tweaked this way, we can get these materials from this supplier. Who do you think knows that? All of our competitors. Every competitor now, if we have to put that information out to protect ourselves from getting sued by Bill LaRock and his crowd of rats, then we have to give away our competitive advantages, right? Our business secrets, proprietary interests in things. And so what do you do? And if there's one thing business doesn't like, it's uncertainty. It doesn't like uncertainty. And unless you have some certainty about certain things you do, business is not going to put their money out there. And so it just created a tremendous, I mean, this went on for 10 or 12 years. It was outrageous. And that's where these two laws came from. They finally went to Congress in 1995, I believe was the first one. 95 is the Private Securities Litigation Reform Act in 1995. And basically what it did was it basically took away their ability to sue them because they said we have 15 million in earnings. They didn't get it. In other words, you had to really have something. You had to show that all of us sat in the room together and said, well, we don't have this and we don't have that, but if we pretend we can do this and we pretend we sold that and we say all these earnings are coming in and we know they're really not coming for another year, but we'll say they came now, and then we're going to say 15 million in earnings, and you can show that, then sure, we should get nailed. We should get nailed in a class action lawsuit. But if all this earnings forecast came out because we honestly believed to the best of our ability, with the best due diligence, that we could get the 15 million, and we didn't, because all of a sudden there was a strike in an area where all the part of the components we got for our technological piece of equipment, we couldn't get them, and LaRock suing us because he said we gave you out misleading financial statements. So Congress said that's nuts. And it is nuts. It's nuts for the whole country. It's nuts for business in the country for that kind of thing. And in any event, so they passed that statute in 1995. Well, you know what? What did the plaintiffs' lawyers do? You'll see further back here, and I won't make any big point out of it when we go through most of the states have adopted very similar securities laws as we have in the 1933 Act and the 1934 Act. They have their own Securities Exchange Commission, their own state commission. They have all very similar laws to their own state matters. Okay. Well, what do you think the plaintiffs' lawyers did there? They just turned around and filed all these lawsuits in the states. So okay, so we can't go to the federal court. We'll go sue in the state court. Same MO, if you will, right? Mode of operation. Same deal. I'm going to sue them the same thing. Blackmail. Nothing short of blackmail. And so finally, you'll see there in 1998, Congress said, you know what? We'll figure this one out. And they killed it. So you cannot do this in the standards. That's what it's called. Let's see, Securities Litigation Uniform Standards Act. And that was the whole purpose of it, was unless you can show the things I mentioned earlier about pretend we have earnings and this and that, unless you can show that, get out of my life. I don't want to talk to you. Don't file that lawsuit. You're out of here. Okay. But so it finally did something about these abuses that went on for, I would say, 10 to 12 years. And in almost all of these cases, if you ever look them up, you'll find that if the suit was for 50 million, the lawyer's fee would be somewhere between 4 to 7 million or more, and the members of the class, meaning you and me, that got ripped off for $2 a package at UPS, we might get a check for $23, right? And it got even worse than that, because it got to the point where here's what would happen. When the case was getting settled, so the plaintiff's lawyers say they wanted $10 million. And the defense lawyers always attack that with a lot of merit and say, 10 million, that's outrageous. We're not going to pay 10 million. And the plaintiff's lawyers say, well, we want 10 million. Well, we're not going to do it. And on occasion, or excuse me, I don't know how often, they would actually win that, and the judge would reduce the amount. So then this makes the defense bar as bad as the plaintiff's bar. They all got together and they said, well, you know what? Here's what we'll do. We as defense lawyers won't attack the amount of your fee. So if you say your fee on this case should be 10 million, we won't attack that. But we still have another 30 million that's due to all the customers. So what we'd like to do is this. In exchange for us not attacking your 10 million, instead of us having to pay out 30 million in cash, we'd like to give out $30 million in coupons. Okay? And the plaintiff's lawyers would say, well, okay, that sounds like a good trade-off. You know why? Because these companies know that when they issue these coupons, if they've got $30 million of coupons out there, meaning, here's your coupon, you can go to UPS and send a parcel for 20% off or something like that, which is supposed to equal the $36 you were supposed to get. They know then that about 20% of those coupons, if not more, will never be redeemed. Okay, so if you're looking at having to give them out 30 million in cash, but you can give them coupons instead, and 20% never get redeemed, there goes $6 million. You just saved $6 million. And you only have to put out 24 million probably, so you save 6 million. So either way, it was a good deal for you. And that's also what's happened in the class action area, which is a pretty disgusting thing. But anyway, okay, let's move on. Okay, so that's in Bill Rock. Bill Rock got caught. I remember reading about him all the time. I mean, he was a very savvy guy, but he was a crook. He was dishonest. He was a crook, and as much as you'd see him interviewed now and then, and me talking about the poor little guy and the this and the that and the big companies taking various people, and to some extent there was truth to that, but not when you make it up, not when you make the litigation up, which is what he was doing, and doing it in an area where, come on, there's a lot of uncertainty in business, and you don't know whether you're going to sell 15 this week and 60 the next week and 3 the week after that. You don't know that. And we've got the same facts. You're doing the best you can. And because of the statutes involved and the preciseness they required, he saw that opening and he jumped all over. And he sued companies because their stock would be volatile. He was doing a lot of it against tech companies whose stock is classically volatile. So if the stock would drop, 10, 15 bucks, bam, he'd be suing them just that fast. And so then, but see, what's supposed to happen is that the person who's been aggrieved, meaning me at my $2 UPS bill, I'm supposed to go to the lawyer. The lawyer's not supposed to come to me and say, how would you like to be my partner in this litigation? We're going to make a lot of money. And that's what LaRocque was doing. And that's unethical. It's even illegal. And I think he's doing about 5 or 7 years in a federal pen somewhere, which is fine with me. Okay. Insider trading. I've already told you what that is. If you look at that Texas Gulf sulfur case on page 636, you could glance at that. That gives you a good example of the insider trading kind of thing. The whole thing is where you have access to knowledge that the general public doesn't. That's the whole idea of insider trading. And there's a little bit there on Martha Stewart. I don't know if you remember Martha Stewart. She was the lady who Martha Stewart Living and all that stuff, and she's always sitting around with bows and wrapping paper and cutting out paper dolls and all that kind of stuff. And she's one shrewd, tough businesswoman, let me tell you. She's worth about 150, 200 million. But she had a pal named Sam Waxel, who was founder and CEO of a company called Imclone, and they were doing researching a drug that was going to do something, I don't know, make us all look like movie stars, whatever. And she had stock in the company. It was a couple 100,000, if that. I forget what it wasn't a lot. No, I think it was less than that. I think it was less than 100,000. And the FDA decided to disapprove the drug, saying we're not going to let you put that drug out. It doesn't pass our requirements at this point. There'd been a lot of hype about it. And Waxel told her about it. And so she called her broker and sold it because he told her it was coming out the next day or the day after that, and she sold the stock. And the feds prosecuted him and her. He went to jail for 6-7 years, I think. She was stupid because if I recall, and I'm not exactly sure the number, but I think she only had $40,000 or $50,000 worth of stock, whatever it was. And if it was 200,000, then this number is what's important. If it was 40, she sold the stock, and I think she avoided about a $4,500 loss. And if the number was 200, I should have researched it before I got on with you all. But if it was 200, she saved something like less than 24,000 bucks she saved from a loss. So in a woman worth 150 million. And in my mind, she got bad legal advice, and/or she's just a hard-headed woman, because she could have gone to the SEC. They filed criminal charges against her, and she refused to plead guilty. And it looked to me like, from what I read, and unless all I have is the papers, but it looked to me like she had done it. She had gotten the tip, and she had sold the stock to save 4,500 bucks, let's say. And I think she got bad advice because her lawyers decided we're going to go to trial. I think we can beat this. And guess what? She didn't beat it. And she ended up, it was pretty famous, she ended up in jail for, I forget it was 6 months or a year. She had 6 to 12 months in jail for that. She's worth 150 million. And remember, she had, was it Margaret Stewart's Media or some such thing? I forget the name of the company. But in the United States of America today, there's no shame because, 30 years ago, you did something like that, you'd go hide in the corner somewhere and never come back in the public eye again. And she was back within 3 months of being out of jail, writing books, make a movie about her. Her company's going gangbusters again. So, what's a little theft and felony stealing among celebrities? Because, why should I be shameful about it? That's what we do. So, anyway, it has nothing to do with this course at all. It has to do with my own personal feelings about some of the behavior we see in this country now with people who get away with it. In any event, okay, Section 5, we're going to finish up. Corporate governance. Corporate governance. Now this one I'm really going to have to be careful not to take you too long because we're about an hour and a half now and I don't want to try to stay too long. But this would really be the more interesting thing for you, but I'll cut it quickly as I can. Corporate governance, the book talks about it as being it involves a relationship between the corporation and its shareholders. And when you say that, you're talking about primarily the officers. But you'd be talking officers and directors and their relationship to the shareholders. Okay, and then the book goes ahead and broadens it. That's the narrow view, and it broadens it, saying it's between the corporation and its stakeholders. And in today's world, that's more the case. Because as we've talked about before, this whole idea of ethical conduct, codes of conduct, the Johnson & Johnson credo, these kinds of things, it plays beyond just the shareholders. And so this idea of corporate governance has definitely become, and part of it too, to a certain extent, may even be PR. Of course, it's good PR for corporations because the newspapers don't hold back telling us about this executive whose company lost $100 million and he got a $5 million bonus. I mean, we see that all the time. And after a while, the public's going to get pretty ticked off about that. In fact, a lot of the public's ticked off about it now. So in any event, that's why we've got stakeholders now being included in this idea of corporate governance, which I think is a good thing, because I think corporations, any sizable corporations, have a tremendous impact on what they do beyond just their shareholders. I mean, that's clear. We all know that, so I don't think that's a whole lot to discuss. Okay, so the book makes this comment, which is that corporate governance, good corporate governance, includes not just complying with the law and the regulations of the agencies that they work under, but also that other dynamic, which to my way of thinking is primarily the ethical part of your business, is the part of your business that really can't be quantitatively determined by numbers and whatnot. And the corporate governance is really a kind of a fairness, do the right thing, watch out for all the people that can be affected by your decisions and so forth. Now, the first thing the book talks about is stock options. And I guess this is cynical time for me. I hate to get cynical about some of this stuff, and I'm not being cynical. This is the truth. This is the way it works. The idea of stock options was this. If you offer your executives stock options, then your hope is that they get their stock options, they get the value of their stock options by driving the price of the corporation, the price of its stock, higher. So they have a right or an option to buy stock at 20, but you did such a good job that year, the stock has gone up to 25, and now you can, for sure, you can sell your stock that was given to you for your work, and make $5 a share. And that was the whole idea of stock options. So the idea was to try to align the shareholders on the one side and the officers on the other. That they were, because the shareholders want to see this. That's why they invested. That's why they bought equity in the company. They want to see the value of their shares go up. Well, who's in a position to make that happen? It's the officers. They run the company on a day-to-day operational basis. And so you want to incentivize them to do something beyond their salaries. And so the result is they came up with stock options. And so at the end of a year, for example, they might say to an executive, I think I have a note down here, let's say the company stock was selling at $20 a share, and they give a senior officer in the company 1,000 shares of stock with the right to buy it at $20 a share in any time in the next 12 months. So if the stock goes above 20, he's going to make a lot more money beyond his salary. Okay, they might give him 1,000 shares at $25 a share in 24 months. So the idea is, well, once you get it, if you get inside the 12 months, you get it to 25, then you can exercise that option and make $5 a share more for yourself. And then the following year, if you get it over 25, you can sell those 1,000 shares, and maybe you can sell that at $28 a share and make $3 a share on that. So that's the idea, except that the numbers are enormous, much, much bigger. And a lot of these stock options for senior executives can be worth $3 million to $10 million a year, annually. Okay, so that was the whole concept. You'd be granted an option. My daughter worked for Microsoft when Microsoft was really going and blowing back in the 90s. And they gave her options. They were big on giving options to employees, and she was one of the earlier employees. And she did exceptionally well as a very young woman because stock that she was given what we call strike price. That is the price that you can buy the stock at, 13. The strike price was $13, and the stock was selling for 40. So it was a $27 profit. And so maybe she had to hold the option for 6 months, or she had to hold it for a year. As soon as she exercised it, if they gave her 500 shares, she made 500 times $20 is what, $10,000, right, or more. 10,000, I guess. So she did very, very well with those stock options. And so in any event, and then of course what happened and then as the company, so let's say the stock went to 30, maybe they gave her options then they gave her 2,000 stock options at 36. So she had to hope that the company, with her work, including everybody else's, would go up to 40. Then she could make $4 a share when she sold those 2,000 options, right? Well, then what happened was Microsoft hit a snag, and she had, I don't know, let's say 5,000 shares of stock at 35, and the stock fell down to 30. And when the option came up for exercise, let's say 6 months later, because she couldn't exercise for 6 more months, otherwise she could have exercised out and avoided the loss, but now the stock's down to 28, and she can buy it at 36. And everybody was thinking by that time it would be 45. Well, it's 26 or whatever the number is, and so she doesn't buy it. So the options expire, and she never makes any money on it. That's the way stock options can work. Okay, but here are the bad consequences. The bad consequences that came out of it was this. And the worst of all was the stories you've probably started to look at anyway, and that's the corporate scandals of the late 1990s and 2000, 2001. The Enron, the Tyco, and that's where these guys, these senior executives, were falsifying the books of the company, showing more revenue, showing greater earnings, because the stock price was driven by Wall Street. And the higher the earnings, the higher Wall Street touted the stock, and the higher the stock rose. And these guys would have stock options. And so if they had a stock option at $25 a share and the stock went up to 50, well, they just exercised their option, doubled their money, except we're talking 10,000, 20, 30,000 shares were their options, 30,000 shares of options at $20 a share when the stock's selling at 40. Okay, so what's 20 times 10,000 shares? It's a lot of money. And so what was happening was executives were cooking the books, putting in phony earnings and whatnot to keep driving the stock price up. The other thing they did was they would reprice the options so that if the stock fell back, then the CEOs and the board would go back and change the pricing. Instead of saying his option was exercisable at 20, the stock had fallen back to 16. They say his option is exercisable at 15. We're repricing it. That option should have been 15, and now he doesn't lose money. They were doing that. And then the last thing they did was backdating options. So the example I have here is the grant was made at $20 a share. It was effective for a year later. A year later, the stock was at 20, so there was no change, and the option's getting ready to expire. So what they do is they backdate the option by the year prior when it was 15. And now the guy with the backdated time frame could exercise the option on the 20 and get his $5 a share that way. And Broadcom was a local company here in California that got caught doing that. A number of major companies got caught. Apple was another one that was involved with it somehow. A lot of companies were doing it. It kind of turns your stomach in a way because, these people get paid well. And, just how far back does the greed, how far does the greed go? But that's what you see. Okay, boards of directors. Boards of directors. This is one where I can get carried away, but I'm going to try not to. Here's something you need to understand about American corporations, and Sarbanes-Oxley has changed this significantly, which is why I thought it was important for you to know about Sarbanes. When my company was bought in the late 1980s, we were bought by a large publicly traded corporation called Primark Corporation out of back east, and they were a big company with billions of dollars in sales and 5,000 employees, big company. And 5,000 employees not that big, but it was pretty good size. They were a Fortune 500 company, so they were one of the biggest 500 countries in the country. What I learned from that was this. I worked for them for about 5 years, never worked in the big corporate world before, did it so I could get some experience and find out what that's all about, and I'd never wanted to work in the big corporate world, and I don't ever want to work there again after I found out. But basically the deal was this. Legally, the way a corporation is supposed to work, be it private or public, but we're focusing on public companies because we're talking about investor and securities acts and so forth. The shareholders own the business, right? The shareholders elect the directors. So the shareholders choose the directors. The directors go out and employ the officers who work for the directors. And they do what the directors are supervising them, and then the officers go do their jobs because they're the experts in their industry and their products and services, and they drive the business, try to make a profit, grow the business, and so forth. Okay, that's the way. If you look at a law book, that's the way it's supposed to work. Well, in the late 1980s, I found out, not to my surprise, that it worked absolutely the opposite. The officers ran the company. The directors did whatever the officers told them to do, and the shareholders were along for the ride and had no real say on what went on in the corporation. And that's exactly the way American corporations ran until Sarbanes-Oxley in 2002. Okay, now you were the owner of a corporation, and the CEO of that corporation could give a crap what happened to you or how you fared because it was his company. All the money that was in his company was his money to do with as he chose. The egos of some of these guys would blow your mind. Our company had $150 million in cash, free cash. And he basically said, we need to do some stuff with this money. I want to use this money. Let's buy some companies. And did he sit down and really have a plan, a strategic plan of how buying this company would meld into his business? He just said, well, what am I interested in? And the only reason they bought our company was because we were in the financial services business. He was in the energy business. He didn't know diddly-do about the financial services business. But all his other buddies, CEOs of big companies, were buying financial services companies. They were getting into the financial services business because interest rates were pretty high, and it was not capital intensive. You just tried to gather a bunch of cash together, and then you invested here and there and moved the cash through the business. You didn't take a whole lot of extra people. It was a sexy thing to do back then, and that's why he bought our company. And our company wasn't worth a third of what he paid us for it, but he just wanted that company. Okay, don't ask me why. Well, I know why. So in any event, so he basically ran the show. So the board of directors were his hand-picked people. I remember what I said under the the proper legal framework, the way it's supposed to be, is the shareholders pick the directors. Doesn't happen that way. The CEO picked the directors, and they were all his buddies. So they did whatever he told them to do. Because in big corporations, they would get paid $50,000 a year, $60,000 a year to attend maybe 4 board meetings. Well, I take that back. I think they probably met every month. I'm pretty sure the boards met every month in big companies. But still, so $60,000. So was that $5,000 a meeting or $6,000 a meeting? I think something like that. So you get $6,000 plus airfare plus lunch, and they're there for like 1 day maybe. And I went to some of these board of directors meetings, and they were just basically just a formality, because the agenda had been prepared in advance. It was passed around everybody. Nobody really sat and questioned. The board had, I think, about 20 members, so it was a huge, unwieldy group of people. A lot of them knew each other. A lot of them were CEOs of other big companies, where our guy, Mr. Stewart, was on their boards. So now, if he's on their board, they better not challenge him on his board meeting, because he's the CEO and chairman of the board of directors. And that was the other thing too. The CEOs were also always the chairman of the board. So they headed up the directors, and they ran all the officers, and they ran the corporation. And pretty soon you can see where it became their company. In the meantime, they've got 100,000, 300,000 shareholders who have their money invested in their company, and his attitude is, well, maybe you guys will get a dividend, maybe you won't. But I'm running this business, and I'm making, $1 million a year in salary and $3 million a year in bonuses and stock options and stuff. So in any event, that's the way it used to be run. And the boards were just a rubber stamp. And here's where the big problem areas were. The big problem areas were in 2 areas. You'll have a board of directors, and you'll have a big public company, and you'll have, let's say you have 20 members of the board. I think now boards are getting to be more like 12, maybe 12 to 20, but it's 12 to 16 range, I think, seems to be what I've seen. Because you can see them in a 10K. You can go, it's public information. You can go get a 10K from Bank of America, from IBM, from General Electric, General Motors, any of those large companies. All the public companies have on file, public record, their 10K. In their 10K, it tells you who the directors are, their ages, their background. It also tells you how much they get paid. You can get the top 10 corporate officers in the company. It tells you exactly how much they got paid the year before and this year, what their salary was, what their stock options were, what their bonuses were. It tells you the whole thing. It's all right there to read. Okay. So you take a large board of, let's say, 16 people, and you had 2 very important committees. One's the audit committee, and the other one's the compensation committee. And the audit committee is the committee usually chaired by the CFO, although sometimes the CEOs would peek in there, but usually the CFO would run the audit committee. And their job was to sit down with the auditors, and so the auditors have to be outside independent auditors. And so in the example I'm going to give you is Arthur Andersen, who happened to be our auditors too. And Arthur Andersen would come in independently, and they'd do the audit of the company, of all its financial condition, to issue a report that said, this is what we think the financial condition of the company is, and with their help, your finance department would put together your 10K and file it with the SEC. Well, you'd get lots of times where the auditors didn't want to treat something the way you were treating. In other words, they wanted to call something an expense and you did not. Or you wanted to call something as revenue received, and they'd say you haven't received it all yet. So you can't call all of it revenue yet. You can only call 10% of it. And you're thinking, wait, if I can call all of it now, I've got another $20 million in revenue. That's going to exceed the expectations of Wall Street. It's going to be higher than our earnings. And guess what? The stock price is going to go up. And guess what? If the stock price goes up, my options are worth more, and I get a bigger bonus. Okay. Well, the whole idea was that the board of directors audit committee would look at that, and they would do what's best for the corporation. Okay. They would say, okay, and they were supposed to be conservative, and they weren't. First of all, they've been appointed by the CEO. Second of all, the CFO is sitting in on the meetings, okay? And he's the guy who battled with the auditors. Now, who are the directors going to side with? Are they going to side with the auditor, or are they Arthur Andersen, or are they going to side with the CFO? Well, do they like having their job where they get $6,000 every month? Plus, they've got their own businesses they're doing. So, but this is just an extra, this is walking around pocket money, $6,000, and your lunch, and meet some of the pals, from the country club and everything. And so, hell yeah, well, we're going to go with the CFO. Well, of course, the CFO and the CEO are motivated to drive the stock price up to get more bonuses and more stock options. And whatever that takes is what they want. And that's where you got into trouble. Because and then you've got the auditors, the Arthur Andersons. Okay, real quick, the poster boy for all this is Enron Corporation, and I know one of you has Enron. And Enron Corporation had Arthur Anderson as their outside auditor, outside independent. Let me get my hands where you can see him. Independent auditor, Arthur Anderson. Arthur Anderson got paid $52 million a year to do their audit. Okay, $1 million a week. Enron was an enormous company. They got $52 million a year to do the audit. Now, if the CFO and the CEO of Arthur Anderson called in the lead partner of Arthur Anderson, who was in charge of this audit, he was the one who ran the audit for Arthur Anderson, which, by the way, was a full-time job. You didn't just go and do it for 3 days. You did it all year long, and then you compiled everything at the end to do the 10K. And he calls you in. He says, you know what, David? The guy's name was David Duncan. He said, you know, David, I want to treat this $30 million as revenue right now. Now, you figure out a way for me to do that or to sign off on it. Because, see, if the auditors wouldn't sign off on the audit, then you couldn't file the report with the SEC, okay? Because the auditors had to approve it. And so David would go back and say, well, let's see, I got $125,000 bonus last year for this account, brought in over $50 million in revenue. I'm on my way to being the third most powerful partner in the firm. I think we can do that. I think we can make that happen. And that's exactly what happened with Enron for about 4 or 5 years. And they cooked the books. They exaggerated earnings, minimized expenses, and drove the stock price up so that when it finally blew up, the stock was trading around $90 a share, and in less than, I think, about 45 or 60 days, it was trading at $3.90. From 90 to $3.90. Now you think to yourself, well, that's terrible. What a terrible thing. Guess what? Over 4,000 employees of Enron, people like you and me, with a wife and family, with a house and a car. Maybe you're my age and you're thinking I'm going to retire in 3 to 5 years. And let's say I had $700,000 tied up in Enron stock. That was my retirement. And it went from being $90 a share to $3. So my $700,000 retirement nest egg went down to $98,000, and I'm 3 years from retirement. You think that had some impact? You bet your life it did. And these guys went to jail, and that's where they belong. And the one guy, I'm of the opinion he committed suicide, although they claimed that he died of natural causes. But Ken Lay was the CEO of the company, and he got convicted and was being sentenced to jail for 25 years, and he died of a sudden heart attack. The other guy, Jeffrey Skilling, who was the president and CEO of Enron, he's in jail now, and he's trying like hell to get out, and I think he's been in there 6, 7 years. He got 25 years. He's in Harvard MBA with a degree in finance. He understands all this stuff, and I listened to him being questioned by the U.S. Senate at one of their hearings before he was tried. And he couldn't remember anything. Gosh, I don't know how that happened. Well, he said, I'm not an accountant. And one of the Senator Feinstein said, well, maybe you're not an accountant, but you got a freaking master's degree from Harvard Business School with an emphasis in finance. I mean, was the stuff your guys were doing with the financial statements wrong or right? I mean, were they playing games with it or not? And then she'd say, here's the game they played. And he'd go, oh, geez, I'm just not familiar with that, Well, he was into it up to here, and he went to jail for 25 years, and these characters destroyed the lives of about 4,000 people. So I have no sympathy for him of any kind. And you'll read about the other people when you do your little paper on these other guys, and you won't have any sympathy for them either. And that's the reason for Sarbanes-Oxley, and it's the least we could have done to try to rectify some of this stuff that went on. And then here's the other one. The other one is called the Compensation Committee, and the CEO and the CFO could heavily influence the Compensation Committee. The Compensation Committee, let's say you had 16 directors, there might be, I was checking the time, I'm almost wrapped up. And by the way, I do about a 3-hour seminar. I don't want to say it's great. I mean, I don't want to say it's like going to see Argo, but I get really into depth with I have some diagrams and stuff about how all this Enron stuff happened, and I've read tons of books on skilling. And Andy Fastel was the CFO. He was a piece of work, and some of these other people with the egos and stuff and all the crap they pulled. And for about 3 hours, I feel relatively certain I can keep you focused on this story, because it is just outrageous what the public suffered under some of these people. But in any event, the compensation committee is the one that these guys influenced. And to give you the worst example of all, I think it's either WorldCom or Tyco, but I think it's Tyco. And the CEO there was a guy named Dennis Kozlowski. And he was kind of a big, ball-headed bruiser of a guy, and he was as arrogant as they come. And you, even watching him walk into the federal courthouse in New York City when they were trying him, he also was doing 25 years with Tyco. He was just so arrogant, and not an ounce of regret or anything that he did. And if I'm not mistaken, he had the company Tyco, through its board of directors, because they had to prove this. They made him a $400 million interest-free loan, which they're in the process of forgiving when the house of cards fell in on Tyco. Now, I didn't say he gave him a $40,000 loan. I didn't say he gave him a $4 million loan. I didn't say he gave him a $40 million loan. $400 million. And that money belonged to the shareholders. Belonged to the shareholders of Tyco Corporation, a public company. And he had that money. Another thing he did was he was out buying famous artists' drawings and paintings, some of them costing well over $200,000. He would buy them with company money and then have them put in his apartment in New York on Central Park, his 2-story apartment where he was living. And he would then but after he bought them, he would have them shipped through, I don't know where they had them shipped through, New York. He had them shipped through some other state where they came in so he could avoid the sales tax. Now he's making like $3 to $5 million a year. He's making $10 million a year in bonuses and stock options and so forth. He's got a $400 million loan, and he's trying to screw the state out of $13,000 in then sales tax. Let's give you an idea of what this guy's like, right? On the loan, it could have been Bernie Ebbers at WorldCom. There was another guy, Bernie Ebbers at WorldCom, who one of you will read about, who he may have had the $400 million loan. I guarantee you, I can take you through all these guys and give you a list of all the stuff they got, and you'd be outraged. If you were on the jury with me, 25 years, we'd be up there at the end of the trial going, Judge, can you give them more than 25? Can you give them life? I mean, these guys are rats of the first order. So anyway, so that's your compensation committee. Now let's talk about that real quickly here. When Sarbanes-Oxley came on, here's the big thing. Prior to Sarbanes-Oxley, so let's say at Enron, they went in, sat down with the Arthur auditors and say, I want to bring this in as $30 million in revenue. They say it's really against the rules. That they have a thing called FASB, Fair Accounting Standards Board, puts out these rulings on how you treat different kinds of income. And they'd say, even though it's against the FASB, we don't care. We want it $30 million. You guys are going to sign off on this. And Arthur Anderson would say, okay, and they'd sign off. Right? It didn't matter at that point for these reasons. One, boards of directors were seldom, if ever, personally liable for mishandling their functions as the supervisors of the officers. Because remember, I said it's upside down. It's the officers telling the directors what they're going to do, and the shareholders along for the ride, versus the shareholders who pick the directors who hire the officers. It's backwards, and still is to a certain extent, except it's more expensive to be an arrogant CEO who doesn't, his sense of fiduciary responsibility to shareholders has been heightened by the fact that Sarbanes-Oxley now says, you take that attitude, pal, and we catch you, and you're going to jail. because before Sarbanes there were no criminal penalties for this stuff. No criminal penalties. So these guys would do this stuff, and they got found. If they had a bad 10K filed, they just restate the earnings and re-sign the new statement of earnings, and they pull out the 30 million and say, "Oh well, we made a mistake." They come up with somebody that made a mistake. The stock would suffer. Okay, the stock might drop $10 a share or $5 a share. It wouldn't toilet; it would just drop. They'd restate the earnings, refile them. The guy could possibly get fired, and sometimes, or what they'd often do is he'd take early retirement and maybe take a $50 million severance package or some such thing like that, and he'd go off down the road. But that was the end, right? You talk about ethics. Nothing will get your attention faster about being ethical than the risk of going to jail for 10 years. And that's true. So, ethics is a wonderful thing, and I believe in it strongly, and I think it should be followed and be demanded at all times. But there are certain things in this world, and you all are all far enough along in your lives to know it, that the only way you're going to get people to act ethically in certain settings is to threaten them with jail. And that's what Sarbanes-Oxley does in this case. So now what happens is when the 10K is brought to the CEO to sign. Now this is something that's been done. The Arthur Andersen auditors have been through all this auditing stuff, which includes reviewing thousands and thousands of contracts and payments and cash coming here and going there, and all the investment returns the company's got, its loans, how much interest expense it has. Huge undertaking. And then it's put together with their financial department, with the company's financial department, and then eventually woven into this 10K, which is a 50, 60-page document with all the financial statements and stuff. And it comes to the CEO and the CFO, and they say, okay, it's ready and it's accurate. And we meet the requirements of the Securities and Exchange Act of 1934. Okay? And they had 33. And they say that. Now the CEO and the CFO have to sign it. And it's called a certification now. Instead of just putting their name on there, they certify that it is accurate, that it has all the material information that someone needs to know to make a determination of the risk of an investment in this company. And they certify it's correct. And if they certify it and it's wrong, they can go to jail for 25 years. I bet fined $1 million to $5 million. So don't you think they take pause now when they sign that thing? Not to mention now the directors can now be responsible for failure to provide, to handle some of their duties and so forth. I forget whether there are criminal penalties against them, but there are penalties in terms of them getting thrown off the board of directors, and they can't be involved with a public company for the rest of their lives. So how do they make a living? That sort of thing. But the CEO and the CFO go to jail personally, that personal liability for lying on a financial statement. And that's where all this took place. When you look at Tyco, you look at the guy, Steve Schwartz was the guy at I think at Tyco or WorldCom, one of the two. But he was the CFO, and then Ebers or Kozlowski were the CEOs. Those two guys, and they both went to jail. But Schwartz was the CFO, so he was doing all this. I mean, he was managing this, and Kozlowski knew he was doing it and encouraged him to do it, I guess, or didn't slap his hand or whatever. Anyway, okay, now here's the really important one, though. The audit committee. This is where this all thing gets out of whack. The audit committee. When Sarbanes-Oxley came along, it said all members of the audit committee, and generally there'd be 5 to 6 members of the audit committee, they all have to be outside directors. Now, what does that mean? Well, was not uncommon in companies for the CEO to be the chairman of the board of directors and to be on the board of directors. And the CFO might be on the board of directors. And there might be several other senior managers on the board of directors. And then, as you might expect, 1 or 2 of them would almost always be on the audit committee. So basically the fox is in the hen house, because now when the audit committee goes to discuss these financial auditing methods and approaches of deciding whether something's an expense or whether it's revenue or whether it's a cancelable contract that's not the value you want to put on it, those people were sitting there. So now the outside auditors are going, oh, let's see here now. I sure like flying to Miami to Boca Raton for the meeting every month. And so pretty soon, okay, if that's the way you want to do it, we'll do it that way. Now, under Sarbanes-Oxley, every member of the audit committee has to be from the outside. So it means that the CFO, the CEO, higher senior executives in the company are not on the audit committee. It seems to make a lot of sense, doesn't it? I mean, you got to scratch your head and say, you got to be kidding me. It was this way for 50 years? It was. It was. And so now they've got to be outside officers. But here's the one that blows your mind. I mean, I know all of you. You got to be kidding me with this one. Now, this is the audit committee. So these are businessmen, and most of them are pretty sharp businessmen. They're from the higher levels of other major corporations. They understand financial statements for the most part, and they understand, growing a company and how you try to posture the company's earnings and so forth to make it look good, and without lying about it, we'll just present it well. Uh, but Sarbanes-Oxley now requires that one member of the audit committee has to be a financial expert. Now that's almost laughable. A financial expert? Are you kidding? In the audit committee? You're damn right. They ought to all have to be financial experts so they understand what the outside auditors are telling them. But up until Sarbanes-Oxley, you could have guys on that audit committee who didn't know diddly-do about finance. They might know about the overview of a corporation's reporting, but they didn't know anything about finance. And a major corporation, like we talked about stocks and bonds, finance is a high-level stuff. It's floating $50, $100 million bond offerings. It's floating $200 million stock offerings rather. It's options, it's warrants, it's preferred stock, it's how you're gonna, it's derivatives, all this complex stuff. And before Sarbanes-Oxley, all that stuff was going on, and these guys in the audit committee might have been the guy came up from the ranks of his company, and now he's the CEO, and the company made automobile tires. Now he's the CEO of Firestone. What does he know about finance? Zero. And yet those guys are signing off on these financial statements, which allowed all this to happen. So finally, Sarbanes-Oxley, some congressman, some smart congressman, finally got a smart one, and said, maybe we ought to have at least one guy on that audit committee have financial background. Maybe be a financial expert. Oh my God. Anyway, I can't get over it. And then last but not least, the other thing they did was on the outside auditors. So you take our friend Dave Duncan at Enron, and he had been with the account, I think, 10 or 11 years or longer. He'd been there a long time. What happens is you make friendship. You're working close with the CFO and some of his immediate underlings, and you get tight with him. You have to. You get friends. You socialize with him. It's his account. It's where he goes to work every day. Well, now under Sarbanes, you have to rotate that person out every 5 years, and that's the reason why, to try to separate that relationship. Because the closer that relationship gets, the harder it is for the outside auditor to say, I'm standing firm on this. This is not the way to report this revenue, and I'm not going to approve it, and I'm not going to sign off on the audit. And if he doesn't sign off on the audit, they can't file the 10K. And if they don't file the 10K, the first thing that hits the Bloomberg Finance Wire or the Wall Street Journal is Arthur Andersen refuses to certify Enron's financial statement that should be filed this Friday, and they won't sign it. What do you think is going to happen to the stock, right? You hear that, and you've got 30,000 shares of Enron stock. That stuff is gone. You're on the phone to your broker in 2 seconds. Sell it, because it's going to drop $5 or $10 like that with that information. Okay, so the auditor now is in a position to say, I'm not going to sign off. And at that point, the CFO is going to have to say, well, let's see if we can rework this. And there's always some compromise. But in the old days, the CFO said, you will sign off on this. You will sign on this, or Ernst & Young will be our new auditors next year. And there you go. That's what was happening. The other one is this, and this is very common in the accounting field. David Duncan might come in there with all of his people. Well, his people could be a staff of 30, believe it or not. There could be a space inside of Enron with a company that huge where they've got 20, 30 people working in their audit, doing ongoing audits all year long, and Duncan's in there managing all this. Well, let's take the 2 or 3 guys under him, and they get friendly with their counterparts in the accounting finance side of Enron's business, which is run by Andy Fastow, the CFO, who's now big buddies with Duncan. And they get friendly with the guys just below him, and there's always openings in one thing or another. And very often what happens, and it happens a lot of times with with young kids out of school who've got their CPA, and they work for small little companies, and they go in there and doing their audits and so forth, public and private, little private public companies. And they work with the owner of the company for a year or two, and he really likes them. And the next thing he hires them to be their CFO. So it has traditionally been a place where a young CPA doing audit work finds a good job as a controller or a chief financial officer of, say, a little company with a couple 300 employees and doing 6 or 7 million a year in sales. They get hired that way. Well, it also happens with the big companies. So these guys working for Duncan get pals with some of the guys in Enron's finance department. And one guy says, you know what, Joe Smith's resigning, or he's retired, or he got a better job. Well, come on, take that job. So now, what do you think the prospects of this second tier guy uh, sticking his heels in the sand and saying, you can't report that way, you got to report it this way? And the other fellow says, no, I want to report it this way. Well, you can't do that. Well, the guy, what this guy didn't say is, you want to have a job here? Are you trying to get a job here when we get an opening? Or do you want to do it my way? So now what Sarbanes says is that you can't go to work for this company for over a year from the time you leave the company. So in other words, you can't, because what they were doing is his resignation on Friday with Arthur Anderson Monday starts just down the hall in the same company, right? With a new job, making 10, 15,000 more a year, and he's happy as can be. And so you can see the problems that creates to prevent these people from doing their jobs, because they're influenced by conflicts of interest all over the place. And so Sarbanes says, no, you don't just leave one Friday and come back as their controller the following Monday. You got to go do something else for a year and a half, and then you can come back and see if the job's open. So you can see what it does. Anyway, okay, last thing and I'm done. Online, just tell you a little bit about that. As you might imagine, that's becoming a problem in online fraud. And they really haven't done a whole lot about it. I'm looking at what I might have said here about it. They talk about newsletters and people with phony websites and all that kind of stuff. They're just starting to try to get into that and get a handle on it. It's a very difficult thing to manage and overcome. A lot of deceptive tactics can happen through blogs, social networking sites, people hiding their true identities, and all that kind of thing. You've got hundreds of online investment letters. One of the examples they give you is a guy has a company. He gets into cahoots with some other fellow who likes to do blogging and whatnot. They develop this newsletter, investment newsletter, and the guy's putting stuff in there. And then, oh, by the way, he takes this fellow's company and banner headlines, just announced the greatest thing since sliced bread. This stock is a buy at $3 a share or whatever. You better go quick. IBM's looking at them. They want to buy them. We hear the price could be 5 or 6 billion, and people go flying in and buying the stock. And these two guys are in cahoots together to tout the stock. And yet a lot of people uninformed look at the newsletter. It's on the website. You go back, look at their website. The website of the company looks like it's the next Facebook, if you will, or Google, and it's all phony. And then the next thing you know, these guys raise $5 million and they're gone. And so that's the kind of online fraud that the SEC is trying to deal with, and it's a big problem for them. And so I just wanted to point that out to you. In any event, that's it. I'm sorry. I guess I started out a couple hours, and I know that was probably driving you nuts. And so here you are at the end of the course, and I'm at it for another 2. But in any event, I hope you got a few things out of this over the past 8 weeks. I wish I'd gotten a chance to meet everybody personally, but of course that doesn't happen. I think a lot of the stuff you've done for me I've really been pleased with. Done some really good discussion boards. I've seen some folks put in a lot of effort. I can see it. I've been doing this for about 15 years, and I can usually pretty well tell when someone's gone way beyond the extra mile, and I've seen that done by a number of people. And I will say that everybody, for the most part, has done a real good job with your writing. I've seen a lot of thought in it, and that's really what I'm looking for, is for you to be thoughtful about what we do here. I just hope that there's some value in you all having taken this course. I guess one other thing I would say is this, and it's a law course, but uh, you will all be able to know when there's something coming up that's got a legal aspect that could be a problem for you or your company. And I'm talking more from a business perspective. But if and when you feel like you need to consult a lawyer, just remember you are in charge, not the lawyer. You may not know the legalities of something, and that's what you hire him for, to tell you, to give you his best advice. But that advice goes over the business issue you're dealing with, and you make that decision. And when you make that decision, you tell him, if I make this decision, what are the consequences? You don't say to him, what should my decision be? Because you intuitively have aspects of the whole issue from your business experience, from your own personal knowledge, from your expertise in your business, which he does not have. And you know about a lot of the other dynamics about whether you can afford to fight with a customer or not, or whether or not you can afford to fight with a vendor, or whether you have to overlook it for now, or there's other things in play that legally you may have a great case, and yeah, you can sue them, but it's going to tie you up for 3 years. It's going to cost you 50 grand. You're never going to get what you wanted to get. Is it better to try to make a deal and go on and do something else? You take your business a different direction, or find a new vendor or something like that. So my point is, you have the ultimate knowledge on what's the best decision in something that involves a legal aspect. And so you use your lawyer to develop options. Now, his options generally will be legal options. And what you want to be able to do is to develop with him business options wrapped with legal paper, if you will, so that you're not breaking the law. You're using the legal principles that are on your side to the maximum, but you're ultimately making a business decision, not a legal decision. So if you take anything in this course, maybe the last 5 minutes is going to be worthwhile more than anything. But you know what you're doing. You know what you're doing with your company. You know what you're doing in your job and your occupation. And if something comes in that's legally oriented or a legal issue related to your business, and you've got college you're talking with about it, or the company, your boss and other people are getting together and you're involved in the conversation, always remember, even though the attorney you get advice from the attorney, but you make the business decision. And as long as he says, to be a little flip, you're not going to jail, but what I really mean is, as long as he's saying you're not doing something you're not doing something unethical, and you're not violating the law, and you're not opening yourself up to a vulnerable position of being sued for something, then you make the business decision. And don't let the lawyer make the business decision for you. Use his knowledge and his expertise in the laws that relates to your business, and then you make the decision, and when you make it, you say to him, this is what I'm planning to do. What are there any problems? And if he comes up with any things, you modify that, and then you go with your decision. Okay? I know from just reading what you all have written for me, and I can get a sense of the way you think. You know what I'm talking about. And I just want to support you with that and tell you, go for it that way. So I hope the course worked out okay for you. Again, and if I can ever be of help to anybody as a sounding board, I'll certainly be happy to do that. So with that, look forward to seeing your research papers. And this is my first time through. I know we've had some bumps and bruises, and I appreciate your hanging with me on that. And wish you all a great rest of the winter. Take care. Bye.